Y lo vamos a hacer con Kevin Thozet, miembro del comité de inversión de Carmignac. Kevin, thank you so much for having us a few minutes in Negocios TV. Kevin, Bank of England took this Wednesday an emergency action to avoid a meltdown in the UK pensions sector. The Bank of England launched a 65 billion bond buying program to stem a crisis in government debt markets. My question is, does it confirm the situation was worse than we thought initially?
Well, yes. In fact, I mean, everybody is looking at what is happening in the UK and whether it is a form of, I'd say, cautionary tale for the rest of us, for the continent and the US. And in fact, the Bank of England intervention is to ensure, in fact, efficient market function, and that was clearly necessary. So they have committed to buying up to 65 billion. They have bought 1 billion yesterday, 1.5 billion today, again, so as to ensure efficient market functioning in this environment. This, I mean, clearly raises some question, and why that is, because if in fact in a period of high inflation, well, markets and central bankers are not playing ball with governments, and there's clearly a risk that too much, I would say, fiscal profligacy will not be well integrated.
And Kevin, what can we expect once the bond buying program is finished?
Well, yeah, that's a very good question indeed, because in fact, what the Bank of England has been committing to is that they will buy up to 65 billion of pounds until the 14th of October. And they said this, and they implemented this emergency measure, even though the Bank of England was signaling and quite awaited to be hiking rates and proceeding to quantitative tightening. You heard me well, quantitative tightening, not quantitative easing. So all eyes will be on what the Bank of England will be able to do. Will it actually stop this emergency program on the 14th of October? But not so long after this, beginning of November, there's a meeting of the Bank of England where, in fact, what is expected is that the Bank of England will hike rates, and market expectations are pretty high on that front. Markets are expecting a rate hike of 1.5% beginning of November, and potentially the start of quantitative tightening at that same date.
And if we see what's been saying in the Federal Reserve, we have heard Bostic, he backs a 75 basis point hike in November and a smaller rise in December. Is this for you the more likely scenario for the US?
Yes, I mean, in the US, I mean, everyone has this inflation problem, so it's very well present in the UK. It's very well present in Germany, as we have seen this morning and this afternoon, and very well present in the US. And unfortunately, there's not much, I would say, authorities can do. And the best approach to do this, to ensure price stability, and this, I think investors have to remind this and to bear this in mind, that the main objective of central bankers is indeed the price stability mandate, and that's what they should be focusing on. So what we do expect for the Federal Reserve to do for its next meeting is indeed 75 basis point hikes. The potential for 50 basis points hikes in December, but in fact, I'd say the risk are tilted to the upside there, and we could see up to another 75 basis points hike as for December.
Today we've known the US GDP stays unchanged at minus 0.6% for second quarter. So we can talk about a technical recession in the US. Meanwhile, we've seen how Kazaks from the ECB says that rate hikes are increasing the risk of recession in the Eurozone. Is the potential risk of a recession greater in our case?
Yes, I mean, clearly the recession risk is much greater, or much closer in Europe than it is in the US. Huh? I mean, in the US, we have seen, as you mentioned, a technical recession. Having said this, consumption is holding very well in America. The US consumer is in, let's say, relatively good shape. There's a very strong jobs market. wages are still increasing at a very high pace and potentially a higher pace than inflation going forward. So this means that in the US, what we are expecting is probably not a hard landing or not a recession, I'd say soon. In the euro area, the risk is very much present because of, well, higher energy prices indeed, because of tighter financial conditions as well. And indeed, the European Central Bank is much more preoccupied by inflation risk, by the recession risk. Again, why that is? Because as I just mentioned, the main objective of central bankers is indeed price stability, and their main concern is to see some form of de-anchoring of inflation expectations, where in fact their credibility will be put in question. So central bankers are clearly very much focused on credibility, and even the Bank of England, even though there could be some questions with again Mr. Bailey and his staff buying something like 20% of outstanding debt on long-term maturities, or buying within a couple of weeks what he has engaged in, I'd say, sell over the coming year.
And with all these uncertainties that we are managing in this moment, which is your investment strategy?
Well, over the short term, clearly cautiousness, and we are navigating, I'd say, uncharted territories these days. We are seeing huge moves on the rates front, but also on credit markets. So what we can expect is more hiking by central banks going forwards. So some cautiousness on this side. When we're looking at longer term yields and longer term maturities, I would reckon to be cautious on that front as well. Why that is? Because again, if the UK is an example of what may happen elsewhere, where we are seeing that those longer term yields are at risk at, I'd say, too much fiscal profligacy as well. On the risk assets, I would tend to be cautious as well. Why that is? Because for a very long period of time, the market mantra has been TINA, that there is no alternative. And today there is an alternative. Cash is a safe haven, and it's paying up to 5% of a yield on short-term maturities in the US. So over the short term, I would push forward a message of cautiousness clearly for those investors who have, I'd say, a longer investment horizon. Well, on the equity side, as I said, I'll remain cautious for now. On the interest rates front, still a difficult environment, but this leaves us with credit markets. I'd say credit markets and high yield credit markets are integrating, I'd say, a fair bit of pessimism. The time passing is helping for those investors, and you have a positive carry. So we can expect volatility in credit markets, but for those, I'd say, most adventurous investors, it could be a good time to start re-entering again those credit markets with yields ranging from 7 to 8% on 2025 or 2027 maturities.
Okay, thank you so much, Kevin Thozet from Carmignac, for this analysis. It's a pleasure.